So over here, this is German 40. I've just pulled up a random like replay tab and I'm just going to go through one of the candles, right? Just to make it easier for you. So over here, you can see that this daily candle was bullish and then the next one was bearish, engulfing it, closing bearish. Now, obviously, after something like this, you can expect the bears to be in control. So the next daily candle, you can see it wicks up first, flips bearish, and then breaks the low. So if we mark out the exact top of that candle, let's mark out the top of that wick and drop to, let's say, the 15-minute time frame. Okay, right here, this is perfect. We can see we have this big 15-minute fair value gap right there. And this was on the day before. So when you go onto the daily time frame, that fair value gap was in this candle right here. This one right here. The next daily candle, the top wick was made on the daily candle first. Then price flipped bearish, continued down, breaking the previous daily low, and then continued down. So at one point, this daily candle was bullish, looked bullish, but that's where you're anticipating to take your sell, to get the top of that daily wick before it flips bearish and continues down to break the previous daily low. So what you would have done is drop to the 15-minute time frame. You can see the previous daily low has not been swept, so you mark out your low. And then you mark out a fair value gap that is in a discounted region. So from this high to this low, we can see it's above 50%. So this is a nice premium area. And then once price taps into this 15-minute fair value gap, we enter on the 1 minute time frame. So we drop our time frame, we look for some sort of market structure shift. Okay, so over here, once we tapped into the 15-minute fair value gap, there wasn't really an entry over here. However, afterwards, once we retraced up and then continued down, breaking this low, we had this 1 minute fair value gap right here, which could have been used as an entry. So we would have entered right there, stop loss above this high, and then we can see price continues all the way down to sweep the yesterday daily lows. So that would have been your trade right there. So just like that, you would have caught a 1 to 9 risk to reward trade, simply understanding how daily candles print. First, the daily candle will open, make its top wick, flip bearish and continue down to break the previous low. That is typically what happens. And then obviously the opposing thing on when it's buying. So the daily candle opens, makes the bottom wick first, flips bullish and then continues up. So understanding the daily candle opens, makes a wick, then flips and then continues. A lot of people enter after the candle's already flipped and continuing in that direction, just trying to get the continuation, right? And that is where you're going to get stopped out or get a break even, because you're going to get some sort of retracement. But if you're entering on the high of the wick of that daily candle before it even flips bearish and continues down, you're already going to be hitting the high risk reward trades, entering right from the top and getting that high risk reward.